Welcome to another video. Today we'll be speaking about risk management. If you don't have a solid risk management strategy in place, it's almost impossible to be consistent in the market. So I will be sharing my risk management strategy so that you guys can take it as free value and integrate it in your own strategy and trading plan. If you're new to the channel, I'm a top author on the TradingView platform, as well as running an educational company and swing trading full-time. If you still haven't, also make sure you go and follow me on TradingView because I share free analysis each and every day. Without further ado, let's get straight in the video and provide some free education to all of you. Okay, so what you're supposed to do when you're about to take a trade and how you're supposed to approach your trading plan from a risk management perspective. So let's take a trade that basically we opened with students this month. So this is a GBP cut long trade, okay, for a simple 1 to 3 risk to reward. Now, before speaking about the risk to reward, there is first a very important step, the most important step. And the most important step is this one. How do I know how much I'm actually risking per position? And this is something that a lot of people, basically people that are new to the market, make a big mistake on. And it's this: they think that their stop loss depends on their lot size. So if, for example, they basically base their stop loss based on the lot size that they enter, which is absolutely wrong. What you're supposed to do is adjust your lot size in order to know how much basically you're actually risking, depending on your stop loss. So if, for example, you have, because the point is this, you need to have a stop loss that is based on structure, okay? It is protected by structure. Your stop loss needs to be protected by the structure in the market. And that is why your stop loss is fixed, okay? You can't move your stop loss. Your stop loss is fixed, protected by structure, and you need to adjust your lot size depending on where your stop loss is and your entry. So how many pips your overall stop loss is. So in this case, for example, we have a 53.9, you can read it here, 53.9 pips stop loss. And it's a stop loss that is absolutely well placed, below structure, protected also by other rules that I can't show here. But overall, this was a very protected stop loss. And how do we know how much? Let's say, for example, like in my case, our risk per trade is usually normally 1%. Okay, we risk 1% of our account per trade. And we want to make at least triple of that per trade. But in general, 1% risk per trade. How do I know that a 53.9 pips stop loss equals to actually 1% of my account on GBP CAD? And this is a very simple calculation you can do also by hand, but there is no need because it's full of calculators out there that they can basically do this for you. So you just go basically, for example, on my Forexbook calculate position size calculator. Okay, you can just Google in my Forexbook position size calculator, and what you can clearly do is just put euro. For example, 250k is your account. You want to risk 1%. Your stop loss, as we have seen, is 53.9 pips, and the currency pair on which you want to open this trade is GBP CAD. You go on calculate and you will clearly see that 1% of your account equals obviously to 2.5k, and the lots that you have to enter within your actual order, okay, will be 6.78. So you will enter 6.78 lots to have basically a 1% risk on this trade. So by entering 6.78 lots at this entry price here with a stop loss here on GBP CAD, you already know that you're risking 1%. And your stop loss is well placed because it's based on structure and not simply on you adjusting your stop loss depending on how much you're willing to risk. You already know that from the beginning. And now we go to the second very crucial, and then we'll also go to the third very crucial aspects of risk management. This is the first one. You need to know before you take the trade how much you're risking and adjust your lot size to actually meet that required risk per trade that is tested because it's part of your strategy. Your strategy needs to be tested. And Once you have this, basically, there is a second part that is you need to have at least a 1 to 3 risk to reward. It's extremely important that you have, when you're trading, at least a 1 to 3 risk to reward. Why a 1 to 3 risk to reward? What does it mean in the first place? It means that if you're risking 1%, you want to make at least 3%. Okay, you want to make at least triple of what you're risking in the position. Okay, and why is this? For the simple fact that if you take 10 trades, okay, and even if you have a terrible win rate, you win only 3 times out of 10, so 30% win rate. So you take 10 trades, okay, you win 3 and you lose 7. Okay, the 3 trades that you win, you made triple of what you normally risk. So basically you made 9%. If you risked 1% per trade, you win 3 trades. Okay, you win 3 trades, you're risking a 1% per trade. So basically how much did you made? You made 9%. Okay, you made 9% because it's 3, 3, and 3. You made 9%. And with your 7 losses, you lost minus 7% because you're risking 1% per position. So here you are losing 1% per position. Here you're making 3% per position. So 3, 6, 9. And overall you can see that you are in profit. So you've been right 3 times out of 10 and you're still in profit. And people think that they need 80%, 90% win rate to actually make money trading. So this is the second very important part. And then it comes the third very important part. You need to know when you have to go risk-free on a position. You need to know when you have to go risk-free. And in this case, when did we actually go risk-free? You need to go risk-free once your stop, basically, when you enter, what needs to be protected is your stop loss. When you're already in the trade, what needs to be protected is your entry, because you don't want the market to go and retest your entry and then continue to the upside. That is not something you want to see, because you're out of the trade break even and then the market continues to the upside. So it's pretty simple that you need to go risk-free when your stop loss is actually protected by new structure. Like in this case, your stop loss is clearly protected by this previous high, which is previous resistance. The market broke above its support. You can see the market also went for a clean retest and then continuation to the upside to our overall target. So 3 things. You need to know how much you're risking and how to calculate it. You need to know the minimum risk to reward ratio that you're aiming for. And you need to know when to go risk-free on your trade. Now let's go to the technicals. Why did we take, just to give some extra value in the video. So why did we even take this trade in the first place? Okay, so let's go from a technical aspect. Now when it comes to technicals, what is very important is basically to know what is going on the different time frames. Okay, what is going on the monthly, what is going on the daily, and what is going on the weekly. Now on the daily time frame, what did we have when we entered this position? So on the daily time frame, we clearly had a market that had created this overextended W formation. After an overextended W formation, you're expecting the market to go back on this level of previous resistance, which is now turned support. So we had a clear retest of previous resistance, now turned support at this area, and we expected the market to make continuation to the upside for the completion of this impulse correction and impulse pattern to the upside. And from a weekly perspective, what do we have? From the weekly, we can clearly see that overall the market made all of this impulse to the downside and then started a nice corrective phase that started to pick up speed and becoming quite basically impulsive. And on the monthly time frame, it's very important to realize that on the monthly, the market created this very nice M formation. And if you remember, I told all of you, expect the market from this low to start a new phase to the upside. I told all of you this on TradingView, and the market in fact started to push to the upside, because that is how the market moves on higher time frames, and how to use the pattern that the market creates on higher time frame to know the direction and take your entries on lower time frames. So overall, by knowing that from the monthly, weekly, and daily, the market is supposed to make a push to the upside, you already know basically what your move was supposed to be. The target, why it's here, for the simple reason. If you want basically information on the next impulse, you need to take your Fibonacci on the retracement. So from the low to the high of the retracement, you quickly see that overall the minus 27 is here. So to be sure that your target will be hit, you can put your target just below the minus 27, which is the first resistance level that the market will encounter in its push to the upside. And overall, on the 4-hour time frame, there are many reasons for which we took the entry exactly from this level. I can't tell you all of them. What I can tell you is that simply the stop loss, if you put your stop loss down here, is protected by structure. This is by structure. This is the simple answer. But actually, the entry, I can't tell you all the rules. I can only tell you that we had some previous resistance to support here. This is the only thing I can tell you. And regarding stop loss, I can only tell you that it was below this low here. So just some simple concepts that you can apply in your own strategy. Enter at structure levels, and stop loss needs to be protected by structure. And overall, the take profit, I already told you why it was here. So this was actually a very good trade for a 1 to 3 risk to reward. And as we already said, if you have a 1 to 3 risk to reward on your trades, you can be right 3 times out of 10, you're still in profit. If you enjoyed the video, make sure you smash the like button and let me know in the comments below. It really does support the creation of more free analysis and education for all of you. If you still haven't, make sure you go check out the mentorship program. It's the best program that there is out there. First, you get all the rules of my strategies, and then you trade them with me each and every day, as well as getting all your questions answered in video format each and every day, okay? Every day of the week. So make sure you go check it out, and if not, make sure you go check out the next video.